Welcome to the Deep Dive, where we dig into complex research so you don't have to. We pull out the key insights to get you up to speed, fast. Today we're doing a pretty high-stakes investigation. We're looking at modern market infrastructure. Our sources are all built around some really cutting-edge financial research. And they examine how digital communication, specifically social media, it's fundamentally changed the physics of market panic. And this whole deep dive, it's really anchored by one single question, a question that should matter to every risk desk, every portfolio manager, and frankly, every regulator. How fast, how strong, and how persistent is negative social media sentiment in actually moving financial markets?
And what makes this so critical right now is that this isn't just a theoretical model we're talking about. The research was validated in the middle of a real-world crisis, a true crucible. We're studying the digital mechanics of the 2023 U.S. regional banking crisis, specifically, the panic around Silicon Valley Bank's failure.
So this is real-time, high-velocity fear.
Exactly.
Okay, so before we dive into SVB itself, we really need to set the stage. Why was this research even necessary to begin with? For years, the industry has leaned on this metric, right? The net sentiment score, or NSS. It just adds up the good and bad comments. Why is that so misleading? Why did researchers feel the need to split the positive and negative signals into totally separate things?
Because aggregation it masks risk. And in finance, if you mask something, you can't manage it. It's that simple. A net sentiment score is, frankly, dangerous. It gives you this false sense of security. I mean, imagine you have 100 positive comments about a bank's great customer service, but at the same time, you have 95 truly terrifying viral posts about a potential liquidity crisis. The net sentiment score looks, okay, it looks slightly positive or, at least neutral.
Right, you just get a reading of +5.
That's exactly, a +5. But in reality, you have this massive, completely asymmetric panic just brewing under the surface. The whole point of this deep dive is that you have to look disproportionately, maybe even exclusively, at that raw negative number. That's where the real risk is.
So if your model is treating a negative comment as just the inverse of a positive one,
you are fatally mispricing volatility. You're missing the entire story.
Okay, that brings us right to the first major breakthrough here, which we're calling the digital panic button. For any traders listening, this part is for you. The most shocking finding is just the raw speed of this digital signal. When researchers looked at thousands of firms using hourly data, what did they actually confirm about the time window? How fast does sentiment hit the stock price?
It arrives. I mean, it is shockingly fast. It basically proves that social media is now the first wave of information. It often gets there before traditional news, definitely before analyst reports. The immediate insight is that the signal from social media hits the stock market in under an hour.
Under an hour. That just changes everything. I mean, the window for a human to intervene, to even vet the source, it's almost zero. Doesn't this basically confirm that only automated high-frequency trading algos can really capitalize on this?
It definitely confirms the predictive edge is tiny, but it's still crucial for human risk managers. The study was very clear on this. The sentiment signal leads the price movement. It's not the other way around, at least not in that immediate term.
So it's a true leading indicator.
For intraday trading, it's the definition of a leading indicator. If you see that sentiment spike, you know the price move is probably coming inside the next 60 minutes.
But speed is one thing. If the signal's weak, it doesn't matter. So we have to talk about the strength. And this is where that core finding, the asymmetry, really takes center stage. We're told that fear is just exponentially stronger than optimism in the market.
This is the strategic conviction that should honestly reorganize every risk model out there. The research confirmed what they call the asymmetric effect hypothesis. It's simple. Negative comments have a much, much more pronounced impact than positive ones.
So optimism is incremental.
And fear is explosive.
How much more pronounced are we talking about? Is this just a slight bias, or is the negative signal just completely dominant?
We are talking about a structural difference in value. It's not even close. For some of the firms they analyzed, the negative sentiment factor was found to have an impact nearly 10 times greater in absolute value than the positive one.
10 times.
Let that sink in for a second. 10 times. A wave of positive hype might give you a small lift. An equivalent wave of fear will slam your stock down 10 times harder.
That's just immense. So, okay, if I'm a portfolio manager, I'm watching my holdings. I see a flood of net sentiment that looks neutral, maybe even a little positive. But the raw negative factor is spiking. What's the takeaway?
The directive is to look at the negative factor and, for that moment, basically ignore the rest. Analyzing total volume or that net sentiment score, it assumes that positive and negative forces are roughly equal. And we now know that's just false. The data demands you focus disproportionately. I mean, you literally need to weight your negative inputs at 10 times the positive ones, because fear is the real amplified signal driving the price.
And if your model doesn't see that 10x asymmetry,
You are fundamentally mispricing your risk and your volatility, period.
let's take this idea now and apply it to the ultimate stress test. The researchers applied this exact methodology to the banking sector. They studied 167 banks, which is, 99% of the U.S. market cap?
Yeah, pretty much the entire U.S. banking system.
And they watched how the system reacted during the SVB crisis.
It was the perfect scenario, really. The crisis was a fast-moving contagion event. It let us test if this digital fear could actually predict physical bank runs and systemic problems.
So what did the digital climate look like before the crisis? In the months leading up when everything on the surface seemed fine.
In the calm months, say from October 2022 to February 2023, the banking industry's digital reputation was robustly positive. The average ratio of positive to negative comments was about 7-to-1.
7 good comments for every single negative one. So high confidence.
Very high confidence, low worry, business as usual.
And then, March 2023, SVB fails. And the digital environment it experiences this rapid, terrifying inversion.
Precisely. During the peak of the crisis, specifically March 9th to the 21st, that 7-to-1 ratio just collapsed. It went down to 3-to-1. But the real moment of pure digital fear happened at the absolute peak of the panic. For certain periods, the number of negative comments was actually greater than the positive ones.
So digital fear just overtook digital optimism.
Instantly. It just reversed years of positive consensus in a matter of hours.
That's the emotional shift. What was the direct, measurable financial consequence of that digital flip?
The market consequence was a complete and total loss of stability. The research showed that the cross-sectional volatility of the entire bank industry index, it tripled during March 2023.
Tripled. For listeners who aren't deep in financial modeling, what does that technical term, cross-sectional volatility, what does that actually tell us?
It's the financial metric for contagion. It tells you how wildly the individual stocks in that sector, so the 167 banks, are swinging apart from each other. When it triples, it means the market has lost consensus. The institutions are no longer moving together. It's a signal that fear is spreading unevenly, right? It's triggering bank runs, targeted short selling on specific names. It creates chaos.
So this is huge for risk teams. Would monitoring social sentiment have given a risk desk an early warning? Something that their traditional balance sheet analysis, which always lags, might have missed.
It absolutely confirms the value of sentiment monitoring for measuring contagion risk. Yes. The model's ability to capture the crisis's severity, its velocity, in real time.
Yeah.
It proves that fear propagation is now a measurable digital metric. It's separate from balance sheet health.
The digital fear signal arrived first.
It arrived first, the price collapse followed, and then the systemic volatility tripled. This is real-time crisis detection in action.
So we've nailed the speed under an hour and the strength up to a 10x asymmetry for negative sentiment. But does this digital damage just, fade away quickly? Or does it stick around? This brings us to the third part of our core question. How persistent is this effect?
The data shows pretty clearly that the influence is not momentary. It's not a flash in the pan. If you're a senior strategist or a crisis comms team trying to figure out how long a digital shock will hit your stock price, the research says the influence is statistically significant for up to 33 hours after the initial event.
33 hours.
Yeah.
So that confirms that a crisis team needs a multi-day defensive plan, not just a single reactive press release. But this brings up the most complex part of the study, I think. Can we say definitively if the sentiment causes the market move, or if the market move just causes the sentiment? The chicken or the egg problem.
This is where the advanced modeling really pays off. The researchers tested for causality, and what they found was bidirectional causality.
Okay, so it's not a one-way street.
Not at all. They're locked in the sophisticated feedback loop. The market influences sentiment, and then that sentiment turns around and influences the market.
Can you give us an analogy for what that looks like in action?
Think of it like a funhouse mirror. The stock price drops 5%, right? That drop immediately distorts the social sentiment. It might trigger panic posts, speculation. Then that distorted negative sentiment immediately bounces back and distorts the price even further. It creates this self-reinforcing digital death spiral that locks the two together. But, and this is crucial, they found an asymmetry even within that feedback loop. Sentiment was found to have a significant greater impact on performance current values, and that influence was sustained over a longer period that 33 hours we mentioned, than the market's influence on sentiment.
So while the market can definitely spark bad sentiment, it's the sentiment that has the longer, more painful tail on the actual stock price.
Yeah.
What's the direct implication there for a firm's monitoring strategy?
It means you need continuous, ongoing monitoring, not just reactive analysis when a crisis hits. Because that digital reputation footprint, especially the negative part, it doesn't just hit you once and then go away. It oscillates. It lingers. It persists. You have a sustained threat window of 33 hours that you have to actively manage. If you treat it like a 1-hour problem, you will repeatedly miss the prolonged pressure on your stock.
Okay, let's finalize the strategic picture here. We set out to answer the 3 parts of our core question about negative social media sentiment. How fast, how strong, and how persistent is it?
And the answers are really decisive. They have to change industry standards. It's fast. It hits the market in under an hour. It's overwhelmingly strong, with that negative factor carrying up to 10 times more weight. And it is persistent. Its influence lingers, oscillating, but statistically significant for up to 33 hours.
This almost sounds like a solved problem. The predictive power is undeniable. So what's the biggest limitation? What's the operational challenge for firms and regulators trying to actually implement this kind of modeling right now?
The challenge is scale, speed, and infrastructure. All 3. The researchers are very explicit about this. Extracting and structuring the, quote, enormous amount of information. We are talking about petabytes of unstructured text data, and then cleaning it, scoring it, and turning it into a decision-relevant signal fast enough. It's a major limitation for most firms.
The volume is just too big.
The volume is gigantic, the computational power you need is immense, and your reaction time has to be minuscule.
Which leaves us with the final, and I think most important, strategic tension. We've established this negative sentiment signal is clearly predictive. It gives you an early warning. But as more sophisticated traders, more risk teams, and more regulators all build these exact same models to spot negative sentiment instantly. And everyone begins trading on that signal at the exact same moment.
The whole question shifts, doesn't it? The market's reaction speed goes from human to purely algorithmic. Does that negative sentiment signal stop being merely predictive of market behavior, and instead does it become actively causal?
Driving the panic itself.
Exactly. Does it start triggering the collapses and accelerating the run simply because the models demand an immediate, automated reaction? The very tool designed to predict panic might become the engine that accelerates it into hyperspeed.
And that is the crucial dilemma for market architects today. A fantastic, really decision-relevant deep dive into the new physics of fear. Thank you for walking us through this critical data. We'll be back soon with another deep dive.